Hi, welcome back to our balance sheet segment. In today's segment, we are going to talk about the next section on the balance sheet, which is the liability section. So last time we talked about assets. We talked about current assets and fixed assets. So your current assets being all of your cash, your receivables, and other assets. And again, just to mention that these are assets that are basically the most liquid, or you can convert them to cash pretty easily, things like that. So you've got your current assets, then your fixed assets again are those that are things that you own, properties that you own, such as could be a building, could be a car, a truck, backhoes, other types of equipment, as well as your accumulated depreciation is tracked there. So you also notice, if you go back and you look at your profit and loss statements, that depreciation that's written off on a monthly basis is captured on your expense underneath your OPEX, which is your operating expenses. And those are written off on a monthly basis, so every year as you depreciate down your assets, those is where you're captured and you get to write off the expense. So that's kind of how that's captured. But so moving on into liabilities. So liabilities are exactly kind of what they sound like. It's money that you owe. So just like your assets, your liabilities are broke down into sections also. Just don't have any cash accounts. So it starts with your current liabilities, and the first one that you probably will see is your accounts payable. And accounts payable are essentially monies that you owe for services that you have asked for, or, let's say you had the printer print up invoices for you, or you had some work outsourced, so you owe another contractor some money. It's rents, it's telephone bills, all of those types of expenses. Anything that you would have spent money on that you captured in your cost of goods sold or your expenses, you're going to see the other side of that here as you're waiting for it to come due to pay. So this is the account where it's held until you actually pay the bill. Okay? Other current liabilities would be liabilities that you're going to pay within the next 12 months. So you've got current liabilities, and then you'll have long-term liabilities, and that is the difference. So current are anything that's due within the next 12 months that you're going to pay out. Long-term is anything beyond that. So under current liabilities, you're always going to have your payroll liabilities, because these, most states you pay your payroll taxes on a quarterly basis. So those funds are captured here throughout the month, and then when you process, then that payment is put against this account, which reduces it down and moves it over to your expenses for the month or for that quarter. So those would be your payroll liabilities. Customer deposits. This is also known as unearned income, and because you haven't earned it yet, it's not really owed to you. So make sure I said that right. So because you haven't earned it yet, you owe the money back, because what would happen is if something happened and you didn't do the work, you'd have to give that money back. So it doesn't really belong to you yet. So you hold it in here as a liability until you actually do the job, and then you move it over as cash. Workers' comp payable, that's kind of related to your payroll liabilities. Some of the other things that you would see in here is on those assets that maybe you took out a loan for, say a building, you're building your property. You would have the asset up here, and let's say it's worth $500,000, and you've had it for, I don't know, say 5 years, and you only owe $400,000. So you would have $500,000 as the price that you paid, and then down here, your current liability is going to be, let's say it's going to be $25,000 for the year. So that is what you would have in your current liability, and then you would have the other $375,000 down in long term, because you only want to capture in your current what you actually have paying out within the next 12 months. And the reason that is when you move into doing ratios and kind of configuring on that higher level of where your business really is financially, that really comes to be important because it identifies your current ratio, which is what tells you if you're a going concern, and that's what the accounting term is for it. Basically, it means, do you have enough money to pay your bills for the next year and survive? That's really what it comes down to. So having these liabilities set up properly, as well as your assets set up properly, it will give you the ability to have faith in those ratios that your accountant should be running for you. If they're not, ask them to, so that you can identify what you can change, what needs to happen, so that you really have an idea of how to plan to improve that profitability. So if we move down to long-term liabilities, in this example, they've got a truck loan. So the only thing that I see that's interesting here is that there's only a long-term liability. So that should have a corresponding account up here that is related to that loan, which is for current, because they should have current payments. So this, to me, I would take a look at. If I was looking at these books, I'd be like, well, where's the current part? Because there should always be a current portion if you have a long-term portion. Even if it's getting close to when the payment is, when you're going to have it paid off, then you would have more in the current rather than in the long-term, because it's going to be paid off. I hope that makes sense to you. So other long-term liabilities are going to be anything that is not due within the next 12 months. So anything that, I'm trying to think of what long-term liabilities you might have. You could have, maybe some notes in there, if you're a big company and maybe you have, things that are going to come due. Say, a company I used to work for, we had some long-term liabilities that were related to the purchase of the business. The business was actually paying for itself, and long-term liability were balloon payments that they needed to make on the company, so payments that were going to come due that were outside of 12 months. And so we would carry those on the long-term liabilities. And that's pretty much what your liability section is. So you've got your assets, okay? Assets equal liabilities plus equity. And that is how we're going to get this number and this number to tie out. So when we come back in the next segment, we're going to talk about equity. It's a little bit more sometimes difficult to understand. Sometimes I even have issues with it because it can get a little, crazy with all the debits and credits. But we'll spend a quick amount of time on that, and then we will move on to the next section. So I'll see you then.